Going on to the intraday chart, we can see the live chart now. So yeah, there you see that the real quite aggressive move down from 125, well, sorry, 127.50, 60. Doesn't look like it's going to go back there in a hurry, does it?
No, it doesn't. It seems very difficult to see what's going to turn around sentiment in sterling in the short term. Obviously, yesterday we saw the market getting hit quite hard in the wake of those comments from Carney. We saw the short sterling strip rallying 5 or 6 beeps quite significantly in the wake of his comments, and that really pushed back against those independent members who were voting for a hike, as I say, in the meeting last week. And of course, we know that one of those hawks has now left the committee. The replacement seems most likely to be much more of a dovish variety. So in a sense,
slightly, yes.
Yeah, the Chancellor seemingly is making sure that the Bank of England aren't going to be moving towards an aggressive tightening bias anytime soon. So without any rate support and with the other underlying dynamics, it is still a case that sterling downside is remaining in play. And it's kind of interesting if you look at the charts, we're getting back to the sort of levels that we haven't seen since mid-April. And of course, why is that significant? Well, that's the day when the election was called. So in a sense, all of that initial sterling impetus after the election was called has almost now been taken out of the market.
Back to square one. How much of this is dollar strength and currency's weakness? Obviously, euro dollar here struggling to hold above 111. So even this is looking a bit sort of on the back foot, isn't it?
It is. I mean, we have seen investors rebuilding euro positions on a fairly significant basis over the course of the last few weeks, and indeed, the most recent positioning data had euro longs at levels that we haven't seen since 6 years, or seen in 6 years. So, in a sense, we've seen a lot of impetus behind the euro, and in a sense, the fact that we couldn't really break up through the 113 threshold, I think, is leaving people a little bit frustrated, and we're starting to see some of those positions sold out now. So, we need a fresh reason to add to euro longs in the current environment. We haven't really got that. So I think we're just seeing a little bit of an unwind of some of those holdings. It will be interesting to see whether, when we get the flash PMIs on Friday, whether that's going to be enough to restock the upside bias in euro. And if we are going to see that, we probably will need to see the data beating expectations, because of course that will start to have some implications for the ECB monetary policy backdrop.
Okay, and then just to finish off with on the live front, dollar yen. That's sinking. I mean, we've gone sort of more risk off here, haven't we?
We have. I mean, it was interesting. We've been trading with sort of between the 100 and 200-day moving averages in the last couple of sessions, and in a sense, we're still generally confined by those parameters. It is a little bit risk off. We have seen some reasons to pair risk appetite in the course of the last 12 hours or so. I think the other variable that in play goes back in a sense to the commodity story in that oil price correction, because of course as the oil price falls, then inflationary expectations, inflationary pressures are dissipating, and so we're seeing yield spreads between treasuries and JGBs compress, and that is a reason why dollar yen is losing momentum.